Okay, so I've started to. I was talking to my son about life insurance. So I was trying to come up with like a super easy way to understand it. So I'm going to show you that kind of what I came up with for him, and how I incorporate it into my practice. And I want to tell you about like a recent thing that happened with life insurance that I know you're going to want to know about. All right, so over here, you can see, let's say we're already on board with taking $50,000 from our IRA and converting it to a Roth. Okay, we're already going to do that. That's the plan. We want to do that for sure. All right, let's do that. However, and of course, we got to get into a Roth, and then we have, it'll grow and grow. And let's say we get eventually, $150,000 in the Roth. We got to pay the fees for the ETFs, right? Maybe a management fee. Let's just say 1%. Just for ease. Okay, $1,500. Well, I didn't need a calculator for that, did I? So $1,500 a year just to invest your money in a Roth. Anyway, it's growing tax-free. That's awesome. All right, so what though if we, instead of taking $50,000 from the IRA to the Roth, we still take $50,000 from the IRA. However, we only take $25,000 and put it in the Roth, and then $25,000 and put it into the life insurance. Now, so this is your life insurance, okay? This is the cash value. So this is how much we're overfunding the life policy with. As soon as you put that first $25,000 in there, you're going to get this huge death benefit, okay? Let me group that up so I can. All right, so here's your huge death benefit that you get right away. So you just instantly leveraged a very small amount to a very huge amount. At this time, though, only can be used for death benefit, if you die, or if you need any kind of long-term care. So that right there, that's not too shabby. You instantly leveraged a little bit of money for a lot for either your beneficiaries or for you if you go into a long-term care facility or you need to bring somebody in, like say you had a stroke. So really all about your beneficiaries at this point, right? Protecting them. So as you start putting more money into this guy, your cash value grows. Your death benefit will continue to grow as well. So every time you put money in, your death benefit will grow. But at some point, we don't necessarily want the death benefit to keep growing. Sometimes we do, but I usually don't design them that way because the fees are going to be the difference between the death benefit and the cash value, right? So this amount right here, the magenta, is going to be what your fees are based on. So obviously, the more your cash value grows, the less the fees are, right? So that's what they're all based on. So if someone comes to me and says, I just want to pass out as much money as I can possibly to my beneficiaries, then we're going to focus more on the death benefit and just make sure that keeps growing. Now the fees are going to be really high, but you can pass on millions of dollars to the next in line there. Usually that's not how I design them. I design it so the death benefit will stop at 200,000, 300,000, 400,000. I just want there enough to pay for a long-term care stay for a couple of years. A lot of clients that come to me, their kids are fine. They're not really looking to give them a huge $1 million payday. They just want to do the most they can, right? So I'm trying to leverage a little bit of money to do the best I can for my clients. All right, so cash value is growing, right? Okay. So the death benefit, remember, can only be used for death or long-term care. The cash value now can come out in any way possible. Anything you want. Tuition, buy a boat, down payment on a cottage or another home, wedding, whatever you want, that can be used for, and I can have it into your account in probably less than 2 days. So it's very liquid. And this money is growing in the market. Okay, this is a universal life. If it was whole life, you just get your flat 4 or 5%. Usually I prefer universal life. You just have a higher potential of growth. And if you want to see how much growth you can get, just ask me and I will show you my personal life insurance statement. And I'll show you how it can grow very fast inside life insurance because you're never taxed on anything, right? This cash value acts like a Roth, okay? Let me make sure I'm covering everything here. Only non-qualified money can go into life insurance. That's why a lot of times we will incorporate it with, a conversion that we're already doing. Whoops. Right. So 25,000 will go into the Roth. 25,000 will go into the life insurance. We're again already taking money out of the IRA. It's already a taxable event. But once it's out, now we can fund a life insurance policy, or we can use non-qualified money, which basically is just any non-retirement money, okay? Brokerage account money, cash sitting at the bank. Remember, If it's not in a retirement account, well, you're paying capital gains every time you sell something. You're paying interest, you're paying dividends, right? So there's a lot going on there. And if you have huge gains, and the stock is going down, maybe in a normal correction, now you got to go, crap, now I got to sell it to avoid capital loss, but you still have a capital gain, and it's just anyways. So you can put that money into life insurance too. That works just well too, because now you're putting it in, and it's like in a Roth, but this Roth is in quotes, of course, doesn't have any rules like you got to be working, you can't make too much, and et cetera, et cetera. Okay, so back to this cash value. This is really gets interesting. The big announcement recently was now the life insurance company that I like, that I prefer for these universal life policies, just announced that the fixed income bucket, so you didn't even have to mess with the market if you don't want to. The fixed bucket is 5.3%. That doesn't matter what the market's doing. That's your fixed bucket that you're going to get. Okay, so that's pretty cool. And it's basically tax-free, right? Love when my dog won't stop barking when I'm doing my videos. All right, so let me move my face over here. So what happens if you want to take out $50,000 from your cash value? Okay, whatever it is. Again, down payment, boat, car, wedding. You're actually not going to take it out of your cash value. Okay, the insurance company is going to loan it to you. Currently, it's 5% is what the loan rate is. Now, what's nice is when you get the contract, that's going to be your guaranteed rate for the rest of your life. They can't change that. So that's kind of cool. And so now we're getting into the area of life insurance where you act as your own bank. Okay, don't let banks make money off of you anymore. You can make money off yourself. Here's how. All right, so if you want money, they're gonna lend it to you at 5%. But here's where it gets interesting. So what I did is I assumed you were putting in $25,000 for, I think, 5 years, 7 years. Don't know what exactly, I don't remember. And then starting in year 10, the compounding of that money is $17,000 in year 10. No, I'm sorry. $15,000 roughly in year 10. Then $16,000 in year 11, $17,000 in year 12, and it keeps going, right? Your money is compounding. That's awesome. So when you take the money, you're not actually taking the money out of your cash value, right? Like I said, they're lending it to you at 5%. So here's where it's cool. I've now said that 3 times, sorry. So let's say it's a $50,000 loan at 5% interest. Here's your $2,500 of interest that you're going to pay. Now, what's cool with life insurance is it's so flexible. If you want to pay just the interest, you can do it. If you want to pay just the principal, you can do that. If you want to pay principal and interest, you can do that. Or you don't have to pay anything, right? And then if you don't pay the loan back, that's fine. What happens is, well, they're just going to take it off of the death benefit when you die. Okay, so your death benefit just got lowered. You don't have to pay back the loan. Okay. In this example, I want to show you, though, what happens when you decide that you do want to pay it off. So on a $50,000 loan, 5% interest, let's say you're paying $25 of interest on that loan, right? But because you didn't really touch your money, it's still growing and compounding. You just made $15,000 of interest compounding in that loan, and you're only paying $2,500 on this loan. So in essence, you're paying down a simple interest loan while your money is compounding still at way more than you're paying for this loan. Okay. So you're paying $2,500. Let's say you're just paying another $500 towards principal every year. So that means you're going to reduce your $50,000 to $48,000. Did I do that right? No, not $500 a month. Just $2,000 a year. So whatever the heck that comes out to. So that means your new loan now is worth $48,000 and 5% interest on that is $2,400. Then let's say you do that again next year, $2,300. So you're paying down simple interest loan while your own money is still compounding at much higher rates than this loan. That, my folks, is how life insurance can amplify things that you're doing in your life. And sometimes we don't even, we're not, using that money to purchase anything. We're just going to slowly borrow against it for a tax-free income stream in retirement that we never pay back. And so that means that it's going to eventually come off the death benefit. So what I try to do is I just try to make sure that this income stream keeps this death benefit still high enough throughout your life that it at least will pay for a 2-year stay in a nursing home. Okay. So that's pretty cool. Now, what's cool, or what's also interesting, is as you put more money into this, in the Roth over there, again, as I told you, your fees are increasing, right? In the life insurance, the fees are actually decreasing because the fees are on the difference of the cash value and the death benefit. So that is life insurance right there. I thought this was going to be a really super simple video because it's kind of simple in my head. But of course, as I kind of try to portray it in real time, I can see how this can get confusing. But hopefully this helps because it's super powerful. You can be your own bank. I put my own kids into life insurance because once you get life insurance, like my oldest is 19, we're going to get a life insurance policy for him. So he'll go through underwriting with no problem, right? Perfectly healthy. So now he's got a life insurance policy. So no matter what happens to him in his lifetime, he's got life insurance. They can't take that away from him if he gets a terminal illness or something like that. But I'm going to have him continually overfund this life insurance because I'm going to have him use the cash value to buy a practice or to buy a building when he's done getting his medical degree because he's going to be a surgeon. So that will give him the opportunity to not even bother with the bank at that point. He'll have the money saved and boom, it's all growing tax-free. It's all going to come out tax-free. It's quite a difference of when you're comparing it to an account where you have to pay taxes on it. Okay. Pretty cool. Let me know if you're interested and we can talk more. Thanks.